The liquidity game you never saw. Analysis. Picture this. Monday, 8 a.m. in London. The city is waking up. The market is not. The game has already begun. Before the open, liquidity is positioned, traps are engineered, and capital is waiting to strike. In Frankfurt, Lagos, Dubai, Singapore, and across the world, retail traders open charts, hunting for an edge. They believe the candles will reveal the truth. They will not. The truth is not hidden in price action. The truth is hidden in liquidity. And most traders never even look for it. Markets move because of liquidity. Liquidity forms where orders pool. Orders pool where retail traders behave identically. This is not random. This is not mysterious. This is the intersection of crowd psychology and market microstructure. This is the liquidity game you never saw. And until you understand it, you are not trading the market. You are donating to it. How liquidity is created. Retail traders love structure. They love rules. They believe safety exists below support, above resistance, and beyond the obvious highs and lows. They believe stop-loss placement is risk control. It is not. It is order clustering. When thousands of identical stops stack under the same level, institutions do not see support. They see fuel. They see liquidity sitting in public. They see a magnet. Price is not drawn there to honor retail analysis. Price is drawn there to harvest retail exits. Support and resistance are not walls, they are gates. And the crowd unknowingly stands at the wrong side of them. The trigger illusion, retail traders worship catalysts. News, earnings, CPI, payrolls, they think this is direction. It is not. It is synchronization. The crowd hears strong payroll data and rushes to buy the dollar, believing momentum will save them. But institutions are not reacting. They are executing. They are waiting for participation. They are waiting for conviction. Retail provides the illusion of direction. Institutions provide the execution of reversal. The crowd trades the headline. Institutions trade the crowd. News is not the cause of the move. News is the appointment time for liquidity transfer. The information, asymmetry, retail traders, analyze candles, institutions, analyze order distribution, liquidity depth, execution velocity, positioning cycles, and latency dynamics. Retail trades pictures. Institutions trade architecture. The battlefield is not the chart. The battlefield is the order book you cannot see, and the speed race you cannot run. Retail thinks the chart is the full map. It is the public brochure. The real map is invisible, dynamic, and guarded by capital scale. You are not fighting patterns. You are fighting positioning and liquidity extraction. The capital fragility. A 10% move against the bank is noise. A 10% move against a retail account is catastrophe. Institutions absorb volatility. Retail accounts implode under it. This fragility forces retail into bad sizing, emotional overfrequency, revenge trading, impulsive exits, and psychological leverage. The enemy is not just price. The enemy is pressure. Retail loses twice, once to liquidity hunts and once to internal leverage and emotional instability. This is not just market risk. This is structural vulnerability. The inversion? If you want to exit the cycle, you must invert your framing completely. Stop asking where price should bounce. Start asking where liquidity is exposed. Stop placing stops where the crowd hides. Start placing them where the crowd cannot endure, holding long enough to threaten your position. Stop trading every signal. Start trading only where liquidity meets asymmetric payoff. This is the difference between analysis and extraction, between reaction and execution, between being hunted and being irrelevant to the hunt. The cost of sameness. Retail traders are predictable not because they are unintelligent, but because they are conditioned. Education taught them to seek confirmation. Markets punish confirmation and reward anticipation. You are not losing because your strategy is bad. You are losing because your behavior is common. The market does not pay for correctness. It pays for uniqueness in execution where liquidity is misunderstood. Liquidity is not found, it is exploited. Liquidity is not a secret treasure. It is a predictable result of mass behavior. Institutions do not chase retail traders personally. They chase the footprints retail traders leave in the market. You must stop thinking in narratives of fairness and start thinking in realities of order concentration and capital scale. The operator mindset operators do not trade reasons. They trade requirements. They do not trade opinions. They trade necessity. They do not seek certainty. They seek vulnerability. The market does not reward the smartest forecast. It rewards the smartest execution where others are forced to exit. Call to action mindset pivot. The market will never adapt to your hopes. You must adapt to its mechanics. The transition from prey to operator begins when you stop trading explanations and start trading liquidity flows. If you want to survive long enough to thrive, you must trade the transfer, not the picture. Impactful candle colors are not the story. Liquidity is who shapes it, who feeds it, who anticipates it, and who survives the extraction. The herd feeds the system. The few study the flows. The operators win by understanding the transfer, not by wishing the hunt would stop. The market is not a puzzle to solve. It is a game to escape first and operate later. And now you finally know the game you never saw.